Yeah, welcome, ladies and gentlemen. After the summer break, it's time for a new virtual online roadshow here with Swiss Resource Capital. And of course, myself, Jochen Steiger. You know me, I'm the CEO and founder of Swiss Resource and the chief editor and also founder of Commodity TV and Rohstoff-TV. And it's my honor and pleasure to introduce to you Canagold Resources. And we have let's say, a little technical problem. This is why we have Knox Henderson here, the Vice President Corporate Development. Good morning to Canada. How are you, Knox?
Good, Jochen. How are you?
Yeah, perfect. Thank you very much. A little bit stressed out because of the technical difficulty, but it is what it is. This sometimes can happen. Scott Eldridge still is trying to dial in the CEO of the company, but Knox is also absolutely able to hold a perfect presentation and to answer all questions. Before we get started, let me do some remarks. As usual, we are fully complying to the European, Great Britain and Swiss data security law. Nobody can see each other. Nobody sees any names nor emails. And please use the chat function for questions. Type them in, and we do, after Knox's presentation, a lively Q&A session. So thank you very much for participating. We have already over 20 people in here, and I would suggest that I bring up the slides, and then I say, Knox, the floor is yours.
Well, thank you, Jochen. It's an honor to be here. I wasn't expecting that this morning, but that's fine because I guess Scott had some issues with his computer.
It looks like he's coming in.
Oh, he's coming in. Okay.
Give it a second. He joined the room. Hang on. Where do I see him? So, does that work?
Well, while he's getting on, I could give a quick summary of Canada. Oh, here comes somebody.
Is he coming in? Whoops.
Hello, Scott.
Ah, there he is. Hey, Scott.
Hey, guys. Good morning and good evening. Sorry I'm late.
Yeah, no problem. We heard already that you had a technical problem. We are already live, Scott, so no funny comments, please. Yeah, ladies and gentlemen, also Scott Eldridge, the CEO of Canagold Resources, made it finally. Fantastic. And so I would suggest, guys, the floor is yours. Please give us an insight into your terrific company.
Excellent. Thank you very much, Jochen. So, Knox, I'm not sure how far you got in the introduction there, but
I got to hello. I didn't even name the company, so over to you. Although I was excited
so Knox,
to do this.
well, welcome everyone, and thank you for listening. I'm Scott Eldridge. I'm the CEO of the company, and I'm also joined by our VP Corp Dev, who's recently new to the team, Knox Henderson. So we'll walk you through the slides today. And then I think we can leave sort of a Q&A for the end. So, Knox, are you controlling the slides here?
You can do it below. There's a button next on the bottom. Yeah, you can do it. Yep.
Perfect. Thank you. Okay. So I'll direct everyone's attention to our standard cautionary note, as we may be making some forward-looking comments throughout the presentation today. So by way of a brief introduction, maybe let's just start with a brief history. So last August 2020, we had a number of corporate level changes, which included changing the name of the company from CanArc to Canagold. And the reason for that name change and rebranding is it does truly reflect our corporate level strategy, whereas in the past, the company had spent time in Canada, the US, Mexico, and other countries. But we've really narrowed our focus now to Canada and British Columbia in particular, where we have flagship asset, New Polaris, that we'll spend most of our time talking about today. We brought on a new director, a gentleman named Andrew Bowering, a mining entrepreneur out of Vancouver. A lot of people would recognize that name. We brought on a new VP of exploration. We had a 5-for-1 share consolidation. And as well, we announced a financing for originally 3.2, and we wound up upsizing that to 8.4 million Canadian. And use of proceeds of that financing, they're being put to work right now. We're drilling at New Polaris, and I'll run you through the drill program and some of the recent results, where we're running 2 rigs on the site right now, drilling 24,000 meters. So at New Polaris, we do have a PEA on the project. It is very, very robust, and we'll talk about those results. In terms of our valuation, I think you'll recognize throughout the presentation here that we are undervalued relative to our peers, and we are led by a very strong board and management that I'll walk you through here. So a quick snapshot of our public company information. We do have 3 listings. Our main listing is TSX Big Board in Canada, and then we have secondary listings on the OTCQB in the US, and of course Frankfurt in your neck of the woods over there in Germany. We do have about 70 million shares outstanding, trading at about 45 cents. So that puts our market cap at about 32 million. And our treasury right now is sitting at about $1 million. And I will briefly point out that the audience is probably aware that we did announce a financing for $5 million Canadian in flow through. We expect a news release of that closing Thursday before market. So that'll top up our treasury, and we anticipate that financing being oversubscribed. In terms of our top shareholders, Eric Sprott is our largest shareholder personally. The Ruffer Gold Fund out of London, England, Brad Cook, our founder and chairman, and then a few high net worth individuals out of Europe and the US. Collectively, those are our top 6 shareholders that control 40% of the company. So moving on to the management side of things, I've been in the business now for about 12 years. I originated out of the insurance industry, which I just found a little dry and unfulfilling. I decided to go back to school, and that catapulted me into the mining space. I started off as an equity buy-side analyst for a German precious metals equity fund. From there, I went on to run my own merchant banking firm, raising institutional capital out of Europe. And now for the last 5 years, I've been on the issuer side of the business, now 3 years as CEO of Canagold. And I had a pre-existing relationship with our founder and chairman, Brad Cook. That's a name that many of you know, obviously, from Endeavour Silver. Brad is also the founder of Canagold, and he offered me the opportunity to come in and lead some changes. And I'm surrounded by a very strong technical team, a team of doers with plenty of achievements behind their names. Gary Biles is our president and COO. He's a mine builder, mine operator. He's done it 4 times. The most notable project on his CV is the SK Creek mine, where he was part of the build as well as mine manager for Homestake before they were taken over. Knox Henderson recently joined us as our VP Corp Dev. Probably a lot of people in the audience recognize his name with his previous work at Great Bear as well as Kodiak Copper, some very successful junior mining discovery plays on the Canadian market. And then another recent addition to our management team is Troy Gill, our VP Exploration. Troy is Australian, a geologist. Obviously, he originated out of Rio Tinto. He twice won their internal award for Discovery of the Year. And prior to Rio Tinto, he actually gained some very valuable underground gold mining experience at Peak Gold Mines in Australia. And that project shares a lot of similarities to our flagship asset, New Polaris. So Troy's a welcome addition to the team as well. And Philippi, a chartered accountant, he's our CFO. So moving over to our board independent directors, Deepak Malhotra, PhD metallurgist. He's our lead technical director. Martin Burian, chartered accountant, chartered business valuationist. He's our lead director on corporate governance. Andrew Bowring is our most recent director to join the board. Again, a lot of people would recognize that name. He's a mining entrepreneur that specializes in taking private assets public. 3 of his more notable companies are Millennial Lithium, Prime Mining, and American Lithium that have all done really well in the last couple of years. And then, of course, Brad and myself on the board. So moving along to the asset side of things, we do hold a portfolio of gold projects within Canada and the US. But as I pointed out in the introduction, with our name change to Canagold, that does reflect our strategy that we spend all of our time and attention now at New Polaris, which is our flagship asset. And in terms of our other projects, the portfolio that we hold, if we're not spending time and energy and money on them, our philosophy is why let it sit there and collect dust. So we do look to option out properties to other companies, and we've done that about 6 times over the last couple of years. So moving on to a brief history of New Polaris. This is a brownfield site, so there was past production here, and there's many benefits to that we'll chat about. The production here was sort of during the 30s and 40s. And at the time, they were mining underground, although very shallow, close to surface, at a grade of 10 grams. And they recovered about 250,000 ounces of gold during that time. Fast forward to today, what do we have? We have an NI 43-101 1 million ounce resource. It's also at 10 grams per ton. That's the diluted grade. May 2020. We ran a PEA on the project at $1,500 gold, needless to say, significantly lower than today's spot prices. And you can see the numbers here, they're very robust. These are all after tax. The IRR hits 56%. The NPV is over 300 million US, all with a very quick payback of less than 2 years. So in terms of what was done in the past year versus how we are moving the project forward, we've taken the flow sheet to another level. The previous production produced gold in the form of a concentrate, and we have a flow sheet designed with auto tech using BIOX, which would allow us to produce doré bars on site, fly them out, and get paid in the same day. That's how the PEA was done, and that's how we'll move forward eventually into a feasibility study. In terms of our location, as I said, we're in our home province here, BC. Our management team, we all sit in Vancouver. So the project is relatively easy access for us. Generally, to access the project, we go in and out of Atlan, the town about 100 kilometers north of us. And from Atlan, it's either a small fixed-wing aircraft or a helicopter ride, and you'll get there in 45 minutes. So as of today, we have a fully staffed 20-person camp. We've got 2 rigs on the site. We're 3/4 of the way through a 24,000 meter drill program. And in terms of the actual property, we own Crown grants here, which means we own the surface rights as well as the mineral rights. That will be very advantageous as we move through the development phase. And we'll just do a brief touch on geology. For those that are familiar with mesothermal gold vein systems, that's what New Polaris is here in BC. These types of systems are not common for BC, but you do see a lot of them over in the Red Lake camp of Ontario. However, one of our neighbors is also a mesothermal system. The Kensington mine, which is owned by Core Mining, is a mesothermal system. They're mining at 6 grams quite profitably. And here we sit with a much higher 10 gram per ton deposit. So that's a good segue into our resource. So as it stands right now, our resource is approximately 1 million ounces. It's split about 50-50 between indicated and inferred. And you can choose a cutoff grade here if you wish. But the grades you see, the 10.8 gram per ton indicated and the 10.2 gram per ton inferred, these already have a 20% mining dilution rate factored in. So in terms of the breakdown of the resources here and what's next for the project, the drilling that we're doing right now is primarily focused on infill drilling. So in order to eventually do a fees, we obviously need to move our inferred up to measured or indicated. So what we're working on right now is tightening up the inferred drill spacing from 40 meters down to 22 meters to move it up category. And then secondarily to that, as a part of this drill program, we're actually looking for more tonnage, more ounces in terms of parallel veins, and also the possibility of down plunge extension. And we'll talk about that. So this is a nice shot of Troy Gill, our VP Exploration. This was taken a couple of months ago up at site, and he's holding a very nice assay result in his hand of 50 grams over a bit less than a meter. And that's reflective of a lot of the results. We started to put out assay results for this drill program. The first one, I believe, was July the 6th. And the results since then have been very, very strong. And the issue that we're dealing with, that every company in BC is dealing with as well, is that the assay labs are really backed up right now. So as I said, we've drilled 3/4 of the meterage, but we've only published a quarter of the results. So we definitely have a steady pipeline coming of drill results. And in terms of when are the next results coming, watch for a news release on Monday. One thing that was interesting in our most recent results was, besides infill drilling, we had a very robust intercept on a parallel vein or on echelon vein that sits about 100 meters above the C-West main vein, which is the host of the bulk of the tonnage and resources. And that intercept was 17 grams over 8 meters and in an area that has no resources yet. So as I said, whether it's parallel veins or down plunge extension, when you're drilling in a mesothermal system, you never know what pleasant surprises you're going to come across. So this gives you an aerial view, an overhead view of the drill plan. So the X's represent previous holes, and needless to say, these are infill holes, and you can see we're filling the density there. And one thing that's important to point out with our project is because it's so condensed and a very small environmental footprint, we actually move the drill around with a dozer versus a helicopter, which you would probably see in the Golden Triangle. And on the map here, you can see the airstrip. So it's all fairly compact, and it's a relatively easy environment to work in. So as I mentioned before, we put out the first results of this drilling on July the 6th, where we saw two very robust drill results. One was 24 grams over 6.6 meters, and another one of almost 16 grams over 3 meters. So as you can see from the section here, those are the red drill holes that are infilling the black drill holes. So again, it's a move in inferred up category. But these drill holes are as expected, but there are some pleasant surprises in there as well. And if you compare these grades to the average grade of our resource, they're above the average. But not only that, our average mining width on this deposit is 3 meters, and we're seeing intercepts that are significantly wider than that. So definitely more of the same. And again, watch for more news coming on Monday. In terms of the results on the C10 that I mentioned previously, the 17 grams over 8 meters, this gives you another section view, just to have an illustration of what I'm explaining here, to sort of get a hold of the relationship, the spatial relationship between the C-West main vein, which is the yellow vein, and then about 100 meters above that, the blue is the C10 vein. So what's interesting here is the C10 vein is very close, and we knew it was there. There are no resources there, however. We do have several intercepts there from the past, but the spacing was just not tight enough to include them into a resource. So it was sort of not directly on our radar in terms of creating a resource there. But now we're seeing that opportunity. We're getting more drill results on the C10, and we can't put a number out there in terms of tonnage and ounces, but we definitely see this growing beyond the current 1 million ounces. This gives you a 2D shot of what the main mineralization looks like. So the green at the top represents the surface, and then sort of the upper left area in brown represents some of the old stopes where the old timers were mining, again, back in the 30s and 40s. And then the yellow area represents the NI 43 1 to 1 million ounces. And you can see the density of the drilling there. And then the down plunge lighter blue area is an interpretation of what we think this could look like down plunge. And you can see two drill holes going into that deeper portion of where the ore body could extend to at about 800 meters. As it stands right now, the maximum depth of the resource is only 600 meters. So we've drilled those two holes, and assays are pending. We do not have the results yet. And I'll just point out the box there, the table with some of the top drill holes that have ever come out of this project. And interestingly, two of the results from July fit in the top 5 drill holes of the project, being approximately 6 meters of 25 grams. So why are we so confident that we can make this project bigger? If we look at analogous deposits, these are all in the Red Lake camp of Ontario, all mesothermal gold deposits. And these are names that the audience would know: Red Lake, Hemlo, Timmins, and Kirkland Lake. These types of systems carry very common characteristics. And the most notable that jumps out at you here is the depth potential. So here we sit in the middle there at 600 meters, whereas it's possible that this could go for 1,000 to 2,000 meters. We don't know the answer yet. Mesothermal deposits can be what I call generational assets, meaning you can go into production with an 8 or 10 year reserve, but lo and behold, 20 years later, you still have a 10-year reserve. And we definitely see that possibility at New Polaris as we continue our drilling here. Being a high-grade deposit, we obviously like to brag and boast about that. Everyone knows that in every mineral, production is constantly being skewed more towards open pits. So the industry average for gold is about 1.35 grams per ton. And here we sit at over 10 grams, which means we're 7.5 times the industry average. And we all know the proverb, grade is king, which is absolutely true. But there's a flip side to that coin. What about the costing side? Yes, we do have high grade, but we also have low cost, where the industry average all-in sustaining cost is sort of in that $1,000 range. And we said at literally half of that, our all-in sustaining cost from the PEA is $530 an ounce. So let's chat about some of the highlights from the PEA. So although we would only need a 750 ton per day mill, because of our grade, this hits the category of $1 billion project in terms of the top line revenue. It'll be about $1.5 billion. The after-tax IRR is 56%. As I said, the EISC is about $530 an ounce. There's massive margin here, whether you measure it in US dollars or our domestic currency, the Canadian dollar. And one of the interesting things that I like to look at is what is the NPV to Capex ratio. Ours is 3-to-1. Again, the NPV is over 300 million, but our Capex is only 110. It's quite unique to have that ratio. And to put the grade in perspective, if this were a mine again, it would be the 6th highest grade gold mine in Canada and the 11th highest grade gold mine in the world. And we still have that blue sky potential. So just to chat briefly about the results from the PEA. So based on the 1 million ounce resource, as I said, we only need a 750 ton per day mill. And that would allow us to produce 80,000 ounces of gold per year over an 8.5 year mine life. So again, these numbers were run at $1,500 gold. We've already talked about the results. I like to look at everything after tax. And the key to really unlocking the value to this project, as I said before, is producing doré bars on site. And that's how we would move forward with a feasibility study. Just transitioning back to our portfolio, we do hold a portfolio of projects in BC as well as Nevada. We don't spend our time and attention on these projects. The money that we raise goes directly in the ground at new Polaris to move forward. But we do create value here for our shareholders, where the option portfolio collectively does cover our corporate G&A. And typically what we look for on properties that we farm out are annual cash payments, annual share payments from that issuer, minimum annual property expenditures, and we retain a royalty upside on the project. And we'll continue to do that as we move forward, as we just keep our focus at New Polaris. So moving on to our peer comp, in terms of valuation, how do we stack up against our peers? So enterprise value per resource ounce is one of the more common measurements. So we sit at about $22 an ounce in the ground, whereas our peers, as we see them, and these are companies with similar stage development in their projects within Canada or the US, they're more as a group in that sort of $45 to $50 range. So as we continue our drilling here, as I said, we've only published a quarter of the results. There's plenty more news flow to come. The way that we're going to catch ground on our peers is to deliver at the project level, and that's exactly what we're doing at New Polaris. So moving on to the summary, in terms of valuation, we talked about enterprise value. Another way is PNAV. We would probably come in at about 0.07 on our PNAV, whereas our peers would be sort of in the 0.1 or 0.2 range. We definitely have our hands full, and we're very excited to work at New Polaris, but we always have our eyes and ears open for new opportunities. If we did acquire something, it would be within Canada and probably a minimum of an inferred resource with expansion potential. As we've chatted about today, we're very focused on this 24,000 meter infill drill program, which will eventually lead us into a resource update and a feasibility study. And with the financing that will close on Thursday, that will allow us to drill over the winter. And what we'll do is we just have to winterize the camp, but we'll keep the same 2 rigs on the site. And this is an opportunity for us because a lot of our peer companies that are, say, in the Golden Triangle area of BC, they do have to shut down for the winter. So that'll be music to the ears of our shareholders as we continue to drill over the winter and have news releases throughout the winter. And lastly, we're led by a very experienced team of financiers, engineers, and geologists. So thank you very much, everyone. I think, we moved through that fairly quickly, but certainly happy to move into a Q&A, Jochen.
Yeah, perfect, Scott. Thank you very much for that. And yeah, let me go here to the chat function. And okay, so, okay, there's a great question I see already. Why are the AISC that low?
Well, good question. They're surprisingly low. They stand out. And these numbers have been scrutinized. The PEA was done all by third-party engineers. Again, Gary Biles, our president and COO, he worked with them on this. He's a mine builder, a mine operator. He's been in it 40 years. The real answer is the grade. We have the goods there on the grade. Again, grade is king. That's a proverb we all know, and it basically means we have to move a smaller amount of rock than another project to produce the same amount of gold.
Okay. Then an investor from Zurich is asking, when do you expect all drill results from the 2020 campaign to be published? And well, the drilling 2021, of course.
Right. So the drilling itself, based on the current program, which is 24,000 meters, will finish in November. But as I said, we're just going to continue drilling because we're about to close the financing, right? But if we just stop drilling in November, we would actually have assay results through to February. That's how backed up the labs are. So as I said, we've drilled 3/4 of the meterage, but we've only published 1/4 of the results. And a lot of the companies in BC and Canada and other parts of the world are dealing with that bottleneck right now at the labs. Unfortunately, there's nothing we can do about it. It just means after we drill, we have a long time to wait before the assays, and we all get impatient there, particularly me. Want to get those results out, but it does mean that we have a prolonged period of news. So again, we could have results through November, results through February, just based on this program.
Okay. What is the First Nations situation, if there is one?
Right. So if you recall the map of British Columbia and the town I mentioned called Atlin, which is 100 kilometers north of us. So that's the town that we go in and out of the camp from, because this is an off-grid project. It is remote, but it is very accessible. So the town of Atlin is 100 kilometers north of us, and it is the home to the Taku River First Nations Tlingit. They go by the acronym, the TRTFN. So we do fall within their catchment, and they are a significant stakeholder in the project, and we have a very positive relationship with them. A few examples of that, when we renewed our exploration permit, the BC government liaises with the First Nations group, and we wouldn't have got their exploration permit renewed without their blessing. And one of the things that they've asked for is employment opportunities, because the town of Atlin and for the band, there's not a lot of employment opportunities. So they do hold 4 out of the 20 positions at the camp right now. So the relationship is very positive. And at this stage of the project, there's no red flags there. And they'd love to see us move this project forward and create more jobs for them.
I can imagine that for sure. Same investor from London is asking, what will it take to make new Polaris road accessible for production preparation? Or is this even needed?
No, it's a great question. So there's plenty of mines around the world that are off-grid, meaning there's no power, there's no road access. And, these are successful mines, whether it be Canada, Russia, Brazil, Australia. Why do they work? Because they have grade. So we undoubtedly have the grade. As I said, this would be the 6th highest grade gold mine in Canada, the 11th highest grade gold mine in the world. And the PEA takes into account that there is no road access, there is no power. It would be a fly-in, fly-out operation combined with barge in, barge out. And our power source would be diesel that we fly in. But there also is a green component to the project where we would probably augment with run-of-river hydropower. So these are all factored into the costing side of things. We don't need a road to make this project work. And that's exactly how it was run in the past. During the 30s and 40s, there was no road access then as well, and they were successful.
Okay, then there's also a great question from an investor in Zurich, meaning, and this is also from my side, we see a lot of inflation these days, right? And the PEA numbers are from 2019. So what Capex do you expect in a feasibility study? I know you have not done yet the feasibility, but do you expect, let's say, the Capex to go up significantly, or do you say, no, we have such good factors, maybe at 10% and we are fine?
Well, the upfront capital cost from the PEA done in May 2020 was 111 million
exactly.
US. And myself as an investor, have we ever seen a Capex be reduced from PEA to feasibility study? No.
Normally not.
So let's be honest. Of course, the numbers will go up. I don't see them going up more than 10 or 20%. There is cost inflation in all sectors, and in mining in particular. You see higher wages, higher power costs, all that kind of stuff. We don't know the answer until we do the study. But keep in mind, this is a 750 ton per day project, so it's very, very small. So when you look at what are the major Capex components, it's the underground mine development, it's the mill, and then it's the BIOX circuit. So we have a pretty close pulse on those items on the costing side. So I would see a slight increase, but not significant.
I mean, even if it would go, let's say, to 140 or 150 million US dollars, this is absolutely financeable with such fantastic numbers, because you did it at $1,500 gold. I mean, if you would do it at 16 or 1650, which would be still, let's say, on the more conservative side, the numbers would be still tremendously to get such a mine financed, right?
Yeah, you're absolutely right, Jochen. But in addition to that, as we see resource expansion opportunities, they're all falling within an eventual mine plan. So we have a minimum goal to increase the production profile from 80,000 ounces to 100,000 ounces. So that will make the project a sort of an order of magnitude better. The market always looks for these million-ounce reserve projects in a fees where you can deliver 100,000 ounces of production over a 10-year mine life. Well, guess what? We're almost there. We have 80,000 ounces over 8.5 years. And that just opens up a much larger audience in terms of institutional investors, analyst coverage, M&A suitors, as another example. The world is looking for that 100,000 ounces over 10 years, and we think we can deliver on that, which would attract a lot more attention from a financing perspective, whether we were perhaps taken out or moving forward to build this ourselves. Those are both potential viable exits for our shareholders.
Absolutely. You said you are already doing like 22 meters drill spacing to get prepared for the feasibility study, which is great, and I appreciate, because I'm also a shareholder of your company. Where do you see the timeline for the feasibility, and can you give us an estimate of costs for the feasibility? Just hypothetical. I know it's a forward-looking statement for the regulators, but just an idea. Does it cost $1 million, $5 million, $10 million, whatever?
Well, I mean, it always depends what you include and don't include in the cost of doing a feasibility study. So,
as you know, I love all in.
Yeah. Well, I mean, one component of the fees that we haven't had an opportunity to talk about is the environmental side. So we're actually ahead of the game on our environmental baseline information gathering. So as of December 31st, we will have completed our third and final year of baseline information in order to submit our environmental permit. So we're ahead of the game there, which is a huge positive. And we see no red flags on the project from an environmental perspective. There's no historical liabilities from the previous production, which is a huge plus. But just circling back to the timeline, which was your sort of original question there, what we are planning on doing after this drill program is a resource update. And we really need to see what the results are from a measured and indicated perspective before we go into a fees. So with the financing that will close, it will give us an opportunity to probably drill an additional 8,000 to 10,000 meters. And we would probably do the resource update first. And then if we saw any gaps, like say there was a component of the inferred that didn't move up category, then we can come back and drill more with that 10,000 meters to still have a very robust M&I category before we go into fees. So we've got some flexibility, some maneuverability there, but we want to deliver a very strong, very robust M&I resource, again, targeting that 1 million ounce reserve. And we're flexible there. But the ultimate next step, as you said, would be a feasibility study. So that actual exercise itself would probably take about 6 months. And the cost would be sort of a fully baked number of about $10 million.
Okay, so it's also doable, of course. Fantastic.
But keep in mind, we have time on our side. Like I said, everyone knows a quarter of the results have come out. So we've got plenty of catalysts to deliver to the market before we even talk about that next year.
Okay, then let's talk a little bit about the status of the old underground workings. Added shafts you have. Do you have to dewater for sure? Can you use some of those, let's say, infrastructure parts, I would call it, and also saying this in the context of that you are now down to 600 meters, and we saw in your graph this can easily go to 800, maybe 1,000 meters. I wouldn't say 2,000 already, but let's say 800 to 1,000 meters. So would it make sense to say, okay, you know what, guys, the 600-meter downwards resource, let's approve that thing, build the mine, and then we drill from underground, for example? And can you use already the old workings?
No, that's a great question. So if you recall from that 2D diagram of New Polaris, the old underground workings were very close to surface. It is flooded now, but there's no sort of operational advantage of rehabilitating the old workings other than probably a vent raise. But we're sort of on another side of the system, although it is parallel, where there isn't really any benefit to using that old infrastructure. So, for example, in our upfront capital cost, we have a spiral decline to access the ore body. So that's something that we'd be doing from scratch. But again, it's already in the costing side. So there's no real cost advantages of the previous production. It was much smaller scale. It was much closer to surface. They were more in that sort of 150 to 200 meter level maximum depth. And as you pointed out, our current resource now is 150 meters to 600 meters below surface. So we're going into a deeper portion of the project, although still close to surface. So to really answer the question, no, there's no benefit to that previous underground mine workings.
Okay, so are you planning to put down, let's say, a hole with 1,000 meters, for example, to test something really below, or let's say that you're going more, let's say, to the 800, 850 meters because you think maybe the risk is lower and the costs are not so high?
Yeah, I mean, we've never drilled below 600 meters, and it is open at depth. The only way we'll know if it's there is if we drill deep, as you said. So as a part of this drill program, if you recall from the slide, I did point out that we've drilled 2 holes down to about that 800 meter level. We don't have the assay results yet. So a lot of the future decisions of future drilling will depend on those results. Even if we didn't hit it at 800 or 900 meters, it doesn't mean it's not there at 700. So I think as a part of the next drilling, what we'll do is we'll maybe to use an American football analogy, we'll march the ball to the goal line, and we'll sort of drill from 600 to 650 to 700 to 750 instead of trying to hit the home run at 800 or 1,000 meters.
Okay, super. We were only talking about gold so far. Are there any other metals associated so far? But I think you would have listed them.
Yeah, we don't have any byproducts. There's no silver. There's no copper. It's not a polymetallic. No base metals. It's just gold.
Yeah, straightforward. That's also not bad. I mean, given the high grades you have, Jesus Christ, this is really fantastic. Yeah, let me check my list here. Yeah, let's talk a little bit about your option out you did with Nevada and Montana and all those kind of things. Have I understood that correct in your presentation, that all the payments you're receiving, the stocks, are paying for the whole GEA per year?
Yeah, so to be a public company, it's not inexpensive. So as I said, from the properties that we option out, we get cash payments every year, share payments every year. They have a minimum amount of money they have to spend on the property. And then we also retain a royalty. So that's the basic premise for every deal. And every deal has been sort of massaged into its own beast based on the merits of the project, or the size or the potential, that sort of thing. So they're all similar, but slightly different. And the answer is yes. Collectively that covers our G&A for the year. So with this financing, every dime will go into the ground, drilling at New Polaris.
That is fantastic. Glad to hear that. That's good. Also, let's talk about some finances here. We saw that you have 11.2 million warrants and 7.1 million options. Can you give us an idea what are, let's say, the average exercise prices of those warrants and options, and maybe some time frames?
Yeah, so the warrants are attached to a financing that we did last summer. So again, we announced 3.2, and then we wound up upsizing that, and we even had to get shareholder approval, which we received overwhelmingly, and we closed on 8.4. So those warrants are attached to that financing, and they have a strike price of 65 cents. Mm-hmm. And we did close the financing in two tranches, so they sort of have two separate expirations, but they also have a call option on them, by the way. So if we trade at $1 VWAP for over 10 days, we can call in those warrants.
Mm-hmm. That would be a nice amount of money to have.
Yeah, and then as far as the options go, you asked about that. The average strike on the options would probably be about 40 cents to 45 cents, and they're to the board and management, as is typical with public companies.
Okay, so there's not a flooding to be expected when the price goes above 50 cents.
Definitely not.
Okay,
yeah, we've got a strong board and a strong management team, and if we're exercising options, we're holding on to them. Yeah.
Definitely. Super. Okay, super. Last question from my side here, because I do not see any more questions popping up. Where do you see now really the next important milestones for, let's say, the next 6 to 9 months, meaning by next summer? What do you really want to achieve?
Well, the answer is drilling. The market loves high-grade results, and it'll be more of that to come. We're just getting a little bit, impatient with getting drill results out. But as I said, we'll have a drilling news release next week. And, these are confirmatory infill holes that are confirming our thesis of a very robust project. So we'll definitely continue to deliver with those strong results. And it'll be mostly drilling as we continue to de-risk and move the project forward. And as I said, trying to move that inferred up to measured and indicated, Jochen.
Super. And when can we get then the next resource estimate? I'm not sure if you said it already for next. You said next year, but maybe we can narrow that a little bit.
Yeah, I think an accurate answer would be Q2 of next year, because I said the assay results, we will still not have them all until February, and then we need time to digest and have the third parties help us with the resource calculation. So realistically, Q2.
Okay, super, perfect. So let me check my list. That looks all good. Yes. Okay, fantastic. Everything's answered here too. Super. That was straightforward, super in time. Scott, thank you very much. Well done. I will look forward to your results on Monday, of course. And please keep us hitting hard with good results ongoing.
That's the plan. No, I really appreciate the time, and thank you very much to the audience. Thank you for listening in today. Thank you, everyone.
Super. Excuse me. Thank you very much. Also, Scott, of course, and ladies and gentlemen, for participating here today. I think Canagold Resources is really a hidden gem, really a company which is not yet really fully discovered, but I think the basis and the foundation here is fantastic. They have enough money. They are drilling, as Scott said, and next year already a resource update, and hopefully then a feasibility study. And I would say then this company is really in the play, because there are not that many high-grade projects out there with 80 to 100,000 ounces gold annual production. And this is something which can really move very fast. So thanks for joining us here, and we will move on next week with Oceana Gold, and look forward to see you all there. So take care, all the best, thanks, and bye-bye from Switzerland. Thanks, Scott. Take care. Bye-bye to Canada.
Take care, bye.
Thank you.